What are you seeing today in the current economic environment? Like, is today really different? We hear that a lot. Today is different. This time is different.
I've always hesitated to say this time is different because I'm a big fan of economic history. I've studied economic history, and what you find is that history tends to repeat itself over and over. At least it rhymes. It's similar over and over. But this time things are changing a little bit, and I'm willing to say at this point that because since 2008, the attitude in Washington is we don't like recessions and we're willing to spend our way out of them. They're doing their best to keep us out of recession, even though recessions are a natural part of the economic cycle. And so given that, it's one of those things that in historic terms, we have a recession in this country. We've had a recession in this country every 5 years or so. So if you go back 160 years, we've had 36 recessions in this country. So do the math, 160 divided by 36, it's about 4.5. So every 4.5 years in this country, we have a recession. We haven't had a real recession since 2008. So what's changed? The government and the Federal Reserve are working really hard to keep us out of recessions by, again, printing lots of money and playing around with interest rates.
Welcome back to the Seven Figure Flipping Podcast. Man, we got one of my favorite guests I think I've ever had the opportunity to interview on the podcast today. Jay Scott, who is what I would consider one of the OG flippers for the new age of real estate investor, and one of the most brilliant minds on economics, especially as it relates to the real estate market. And he has a ton of experience flipping houses himself. He buys a whole bunch of apartments smartly with Bar Down Investments and his team over there. He's just an all-around, very savvy, very credible real estate investor in the market. He's amazing. And Jay, I'm excited to have you on the show. Welcome to the show.
Hey, Adam, I'm thrilled to be here. Thanks for having me.
And obviously, if the audience doesn't know you, which I'd be shocked, you are a BiggerPockets mainstay. You hosted a variation of shows over there. Well, what show are you hosting now there?
Yeah, so I'm actually not hosting anything over at BiggerPockets. Okay. My wife and I co-hosted the BiggerPockets Business Podcast for a few years, back in, I think, 2018 to 2020 up to COVID. And I find myself as a guest on podcasts probably once or twice a month on the various BiggerPockets podcasts, but not hosting anything right now.
And you have the Drunk Real Estate Podcast.
Yeah. So a few friends of mine and I get together once a week, 4 of us, and we drink a little bit and we talk real estate and investing and economics and politics, whatever happens to be going on in the world that week. And we try and make it educational and also fun.
Oh yeah. It is very, you guys do such a great job of just illuminating different topics about what's going on in economics, how politics are affecting the market, and what's going on in real estate sometimes too. Really great show. You, for sure. I think Kyle and AJ, right?
Kyle, AJ, and Mauricio Raould.
Oh, and Mauricio, that's right. Yep. He's a real estate attorney. So yeah, great show, a show that I frequent myself and would recommend all of our listeners to listen to Jay on there. He knows what he's talking about. Okay, cool. Jay, for people who have been living under a rock, can you tell them kind of your background, who you are and what you do?
Yeah. So I'm a reformed engineer and business guy. So have an electrical engineering degree, MBA, spent a couple decades in the tech world, doing tech stuff, corporate stuff. And then in 2008, my wife and I decided to get married. We were both working ridiculous hours, 80 hours a week. She was traveling 3 weeks a month. I was traveling a week and a half a month. We never saw each other. We wanted to start a family, and we just knew that the whole tech lifestyle just wasn't going to cut it for us. So quit our jobs, moved from Silicon Valley to the East Coast, and said, hey, let's figure out what we want to do next. This was summer of 2008. And we had no idea what we wanted to do, but every time we turned on the TV, there was some house flipping TV show. And my wife, who's big into design, was like, I'd love to flip a house so we could come up with cool designs for it. And we had literally just bought our first personal residence ever. So I knew nothing about renovations or flipping houses or buying real estate or anything. But when the woman you're about to marry decides she wants to do something, you just say, okay, let's do it. So summer of 2008, we decided to flip a house, and that turned into 2, turned into 10, turned into 50. And at this point, I think we're over 500. We've slowed down a good bit since then. Most of our flipping these days is with passive. We're passive with other investors doing the active work. We focus on buying and syndicating apartment complexes these days, but we still dip our toe in the single family world and are still doing some flips here and there.
Yeah. Well, first off, you jumped in. Carol said, let's go. And you jumped in. What I think is really cool, you have an engineering mind. You're a kind of data-driven person. So my personal opinion is that bodes actually really well for house flipping, where, a couple of numbers really can decide whether or not you're going to win, like guessing the after repair value and then dialing in a detailed rehab.
So that's part of it. The other part of it was just the business side. Look, people ask me like how I was able to flip 500 houses in like the first 6 or 7 years that we did this, especially back in 2008 when the market was just in the toilet. And the reality is it's because I didn't know any better. If I knew back then what I knew now, one, I probably wouldn't have started back then in 2008, even though it was a great decision. I wouldn't have thought it was a great decision if I knew then what I know now. And two, I certainly wouldn't have felt like I had the ability to scale that quickly, knowing all the challenges that I was going to face. But luckily I didn't have those limitations, those mental limitations, because I didn't know anybody else that was doing this. And so I didn't know that flipping 20 or 30 houses a year wasn't a common thing. I mean, I just assumed that if you're flipping houses, you're doing a bunch of houses. But here's the biggest thing that I think helped us, and that's that we knew absolutely nothing about real estate. I found that people that come in as they were real estate agents, or they're contractors, or they're something else in the industry where they have some knowledge, they feel like they've got a leg up, and they feel like when they jump in and start flipping houses, they can be really hands-on. Especially people that have contracting backgrounds. They're like, why would I hire a painter when I can paint this for like a third of the price myself? Why would I hire a plumber when I know how to do plumbing? And so what they end up doing is they end up focusing on all the tactical stuff as opposed to the strategic side of the business, building the business, hiring the right people, putting the right systems and processes in place. I couldn't do that. I'm an electrical engineer who my wife would say can't even change a light bulb. And so from the day we started, I never tried to do any renovations myself. We never tried to be the real estate agents and buy or sell the houses ourselves. Never tried to be a mortgage broker and try and deal with the loans ourselves. We always brought people in who knew what they were doing. We built a team around us, just like the big companies we had worked for previously. And we said, look, we don't know what we're doing, but we're going to surround ourselves with people who do. And that's what really allowed us to build and grow and to scale our business, that attitude of let's treat it like a real business as opposed to treating it like a hobby where we're doing everything ourselves.
Yeah, that's something we see a lot is house flippers join our community. They come from a construction background. I have two community members recently. One guy, older guy in Michigan, his name's Tom Bell, wonderful human, gets his very first house flip and does the work himself. Ends up making 10 grand on his first deal. All is well, didn't lose money. Obviously, we all know that's a huge win. And the whole time we're going, Tom, you got to hire this stuff out. If you're in that house, you're not saving money. And when you do the math, it took him 4 times as long as he thought he would take him doing it himself. And then when he ran the numbers on holding costs, he could have just hired the people to do it and probably done 2 or 3 more in that same time.
Here's the way to look at it. Here's the way I've always looked at it. If let's say you go in and you paint a house yourself. And let's say by doing that, you don't have to hire a painter at $25 an hour. How much are you earning per hour flipping that house? You're earning $25 an hour. The money that you're saving by not hiring a painter and doing it yourself is $25 an hour. That's what you're earning. I don't know about you, but I didn't get into being an entrepreneur or real estate investor, a house flipper to make $25 an hour. I got into this business to make $100 an hour, $500 an hour, $1,000 an hour. And I can't make that money by spending my time doing a $25 an hour job. I need to be focused on the $500 and $1,000 an hour jobs, and I need to hire out the $25 an hour jobs.
Yeah, absolutely. I mean, talk about this ad nauseum with our community on this podcast. Let's get right to the good stuff. I don't want to save this for the end. You wrote the book on flipping houses, one of the best books BiggerPockets has ever published, in my opinion.
I appreciate it.
And with all that experience, right? So you started at a time where people probably thought you were insane. You obviously didn't know any better. Turned out to be good. And you did 500 house flips and you're still involved. Like, what is the absolute best piece of advice you could give to a house flipper today, whether they're just starting or they're midway into their business?
So the best piece of advice is for those who have never done a deal. And so I like to say that I meet two types of people in this business, and I meet a lot of people, and they always fit into one of two groups. Either they've never done a deal, and that's probably 90-95% of the people I meet, or they've done 10, 20, 50, 100 deals. And that's the other 1-5% of people I meet. There's one type of person I never, ever meet in this business, and that's somebody who's done one deal. Nobody in this business does one deal. And the reason for that is if you can get to that first deal, and getting the first deal is hard. I mean, it can take a lot of time, a lot of effort, a lot of stress, but you get that first deal and everything kind of clicks. And that second deal is so much easier. And the third deal is so much easier after that. And by the time you get to 10, 20, 30, 50 deals, it's a no-brainer. Basically, you're on autopilot hopefully with your systems and processes. So my biggest piece of advice to anybody out there, if you haven't done that first deal and you feel like I don't know if I can make it in this business, just make a promise to yourself that you're not going to stop until you get number one. Because if you get number one, you're going to get 2, 5, 10, 20, 50.
Yeah, it's a belief change, I think, for a lot of people. Like they hear us on the podcast, they see the people and they're like, I really want that. They start it, they realize, hey, there's some challenges. It's not the easiest thing in the world, but you do get better over time. It does feel easier. Your skill goes up. But when they do that first deal, to just watch people, their belief system, their mindset, like they surprise themselves, even though they know they're going to do it, right? Like they're like, oh my gosh, I did it. I made some money. This is crazy. So it's really cool. I mean, I'm so grateful and fortunate to be a part of a lot of people's businesses in our world where I get to watch that evolution. And you're exactly right. We talk about this all the time. Like I can teach you how to make all kinds of money in real estate, but like what I really would be the best coach for is to help you. I believe in these people sometimes more than they do, because I've seen, very average people like me be able to do extraordinary things. And I'm like, you're more talented than I am. Like once you do that first one, it's going to be game over. So I love that. I absolutely love that. Hey, so I'm following you every day. There's a lot of stuff going on in the economy. There's a lot of data out there. We're questioning the data, like certain indicators that would typically mean something would happen. It's not happening and we don't know why. And all this uncertainty is out there in the marketplace. And we talk about with the investors is, hey, there are market cycles and people make money in every cycle. Some are more constrained and more challenging. Some you have tailwinds. At the end of the day, there is opportunity in every market cycle. Like people are still making money. What are you seeing today in the current economic environment? Like, is today really different? We hear that a lot. Today's different. This time is different. Is today different? What are we seeing?
I mean, certainly there are things that are different about today's economy and kind of the economic cycle than in the past, simply because the government, the Federal Reserve, our monetary system is behaving a little bit differently than they have in the past. I've always hesitated to say this time is different because I'm a big fan of economic history. I've studied economic history, and what you find is that history tends to repeat itself over and over. At least it rhymes. It's similar over and over. But this time things are changing a little bit, and I'm willing to say at this point that because since 2008, the attitude in Washington is we don't like recessions, and we're willing to spend our way out of them. We're willing to print ridiculous amounts of money. We're willing to do crazy things with interest rates, anything to stay out of a recession. And this isn't a partisan political thing. We've seen this across the last three administrations, three different presidents, four administrations, two different sides of the aisle. They're both doing the same thing. They're doing their best to keep us out of recession, even though recessions are a natural part of the economic cycle. And so given that, it's one of those things that in historic terms, we have a recession in this country. We've had a recession in this country every 5 years or so. So if you go back 160 years, we've had 36 recessions in this country. So do the math, 160 divided by 36, it's about 4.5. So every 4.5 years in this country, we have a recession. We haven't had a real recession since 2008. So what's changed? The government and the Federal Reserve are working really hard to keep us out of recessions by, again, printing lots of money and playing around with interest rates. And so prior to 2008, going through a recession wasn't a big deal. It happened all the time. Now it doesn't happen very often. And so people aren't accustomed to it. People hear the word recession, and what they think is 2008. Because most of the people that are in real estate today they're in their 20s or their 30s. If you're in your 20s or your 30s, the only recession you really remember, let's ignore 2020 because that was a weird one, but the only recession you probably remember is 2008. And so when you hear the word recession, you think, oh my God, the sky's falling, the world's collapsing, economic collapse, everybody's losing their jobs, everybody's losing their house, the real estate values are getting cut by 20, 30%. But the reality is that was a one-time event in 2008, or a two-time event. It happened back in the Great Depression back in the 1930s. But I said there have been 36 recessions in this country in the last 160 years. Those were literally the only two times that real estate took a big hit. The other 34 recessions, real estate either flattened out, kept going up at a small clip, or maybe dropped a 0.5%, 1%, 1.5%. But we never, other than 2008 and the 1930s, we never saw recessions impact real estate to a large degree. And so when you hear the term recession, sure, you can't rule out that the next one might be like 2008 or 1929. But the reality is it's more likely to be like the other 34 recessions where things aren't good. People are losing their jobs and there's some inflation and eventually there's deflation and there's some foreclosures and there's some bankruptcies. But at the end of the day, the real estate market just kind of keeps chugging along. And so what I tell people is don't fall into that doom and gloom mindset that even if you think there is a recession coming, and I think there probably is one coming, it doesn't mean real estate's going to collapse like it did in 2008.
That's a great point. Jay, I interestingly, like when we got a couple hundred house flippers who are on the ground day on, stay on. They list a house on the market. It starts sitting longer than they're used to. Yep. They start clenching up and the chatter starts. And I'm like, I'm a data guy. I'm not an engineer like you and Bill, but I'm still a data guy. I like data. I like facts, right? So I'm like, okay, well, cool. We're in the business of risk acceptance. So everything we do, we accept some level of risk. And our job is to mitigate that to the best way we possibly can. So I said, let me go back and look at what has happened negatively in the housing market. Like you said, 1929, which is a whole different economic world, by the way, which I know you know that. And then 2008 are the biggest drops in real estate prices. I'm like, cool. How much has real estate dropped? Like if I had to adjust for the worst case scenario, what would it be? So then I look at 2008 nationwide, 25% drop. Some reports say some markets locally, 40%. If you look at Nevada and Miami, 40, 60%, big drops there. But I kind of even it out and I go, okay, but here's the thing. They dropped over time, a period of time, 2008 to 2012. It didn't happen next month. And you think about the cycle of a house flipper, which you well know is 6 to 12 months. We're in an asset for 6 to 12 months and we're turning out of it. Okay, cool. So I got a plan for that. So what is a reasonable worst case scenario? I say, my opinion, 1% a month. So if I'm gonna buy a house today and I think I'm holding it for 9 months, just knock 9% off of the after repair value, and it would be really hard to lose still.
Yep. And here's the way I look at it. So you said 25%. I think across the country in 2008, the numbers I've read are somewhere in the 21 to 22%. So yeah, low 20s. What's the average margin, profit margin for a house flip? In my experience, it's somewhere around 15% if you're at scale. If you're doing kind of one-off deals, smaller or fewer deals, then it might be 20, 25%. But even at scale, you're probably at somewhere around 15% margins. So in an absolute worst case situation, you buy the house like the day before the drop starts. Then you have a 2008 type event where the market drops 20, 21, 22%. And then you sell the house the next day after that you hit the bottom. Your 15% margin now reverses by 20, 21, 22%. You've lost 5%. That's an absolute worst case scenario. I'm not going to say it's the worst case scenario because, like you said, there are some markets that did worse. And certainly if you make bad decisions, you spend too much, your holding costs are too much, et cetera, you can still lose a lot more money. But a good house flipper who's following the rules, who's doing the right thing, who's being conservative in their numbers, even in the most unlucky scenario, given economic factors, you're probably not going to lose more than 5 or 10%. And it would be difficult in most economic situations for the market to turn a 15% profit into a loss. So what I like to tell house flippers is you have to learn. You have to study. You have to put best practices into play. But if you put the best practices into play in your business and you do things right and you underwrite well and you make good decisions and you're conservative in your assumptions, then what you're pretty much doing is you're mitigating almost all the risk from a 2008 type event.
Yeah, and I think like that, when we get that data in front of some of these really good house flippers, I think it gives them a little more confidence. Anytime we see somebody struggle, it's honestly user error. They bought too high, they sat on it too long, the rehab scope was underestimated. They found more things. It's always something that we did. Or probably the worst thing that I see today is overpricing houses in an environment where we have an affordability issue, which is what I'd like to just kind of go into that a little bit, because we look at the history, and the real estate market has done what it's done, which gives us a lot of confidence. But have we ever seen a market that has this kind of an affordability issue? And maybe that's the big concern going forward.
We haven't. And so affordability is at an all-time low right now. Housing prices are, I'm going to use the term, in a bubble. I hate that term because the assumption is when you use the term bubble that there must be a situation where that bubble pops. Right. So, and I don't think that's necessarily the case. But the reality is that home prices historically adjusted are overinflated. And so when we talk about what does overinflated mean, like what should they be priced at? Do we have a benchmark? And the reality is we do. So if you look at 1900 through 2004 and you track home value increases over that 104 years, what you'll find is value increases almost exactly tracked inflation over the same period of time, from 1900 to 2004. Then 2004, a weird thing happened. We saw housing prices kind of diverge from the trend line, that inflation trend line, and things got really expensive. 2008, 9, 10 come around and values came crashing back down. And by 2013, we were back where housing prices over 113 years, 1900 to 2013, basically were aligned with that inflation trend line. Basically, over 113 years, housing prices went up at the rate of inflation, about 3.1%. 2014, 15, we started to see that divergence again. And now here we are 10 years later, and housing prices are well above the inflation trend line. So the question is, does that mean that housing prices need to come crashing back down to the inflation trend line again? Well, I think that's one possibility. it's possible that we'll see a 2008 type event, or not so bad or worse, who knows, where housing prices come crashing back down and we kind of reconverge on that inflation trend line. But I think a more likely outcome is that housing prices for the next 5, 6, 7 years will be relatively flat while inflation catches up. And those two trend lines will intersect again about 5 or 6 years down the road without real estate coming crashing down. And the reason I think that's more likely is because the biggest driver, like I just said, of home prices is inflation. And if you think we're going to continue to see inflation for the next 3, 4, 5, 6, 7 years, it's very likely that home values are going to continue to be propped up. And so are we going to see inflation for the next several years? I think we are. It feels like we're in an inflationary environment. There are a lot of economic factors that are converging that are kind of driving inflation up. We're printing a lot of money. We've got some weird trade policy these days. We're seeing high demand on the investor side. There's something like $300 billion in investor money sitting on the sidelines looking for a home in real estate. A lot of people want to buy a house, but have just been priced out. And so as wages start going up over the next couple of years, they'll be priced back in. If interest rates start to come down, they'll be priced back in. So there's a lot of reasons to think that real estate is going to be propped up for the next couple of years, and we're not going to see this 2008 type crash. And then at some point, again, 5 or 6 years from now, the data looks like those two trend lines, real estate values and inflation, will kind of converge again. And in 5 or 6 years, I suspect we're going to say real estate prices are now back to where they should be without that big crash.
I just really appreciate that kind of pragmatic look at that based on data. So when we talk about affordability, so we have, wage and wage growth. So how much money people make, and that determines what they can afford to buy. If you listen to any financial person, they'd like to see you keep your housing costs under 30% of your income. Just as a rule of thumb. And obviously real estate values go up, but wages don't grow. What are we seeing in the current environment? Is there a world, a scenario where we see a bigger wage growth? Maybe housing stagnates, but wage growth comes up. And how do you see that affecting businesses?
Yeah, so I think certainly we're going to see wage growth, and it looks like wage growth is a little bit above inflation. Inflation these days, according to government numbers, whether you want to believe them or not, is somewhere around 3%. Wage growth is wage growth is somewhere around 4%. So in theory, we're making more money in inflation-adjusted terms, real terms, every year. And again, housing prices, I don't expect are going to go up anywhere near that 3 or 4% rate. So I do expect over the next few years that we're going to see wage growth and salary, total income approach a number that's a lot more reasonable for where real estate is currently priced. It might take a couple years, but in the meantime, the nice thing is, again, there's a lot of demand out there. There are a lot of people who want to buy houses. There are a lot of investors who want to buy houses. And then there are a whole lot of people who own houses, who bought houses back in 2018, 19, 20, 21 at interest rates in the 2, 3, 4% range. If we start to see interest rates come down in the next couple of years, and I don't think it's going to happen quickly, we can talk about that separately. But when we start to see interest rates start to come down a bit, I think a lot of those people who are holding off selling because they've got a great interest rate are going to be more willing to sell and move into a new property. And so I think that'll drive supply because there'll be more people selling, but it will also drive some additional demand.
Yeah, I think we should talk about interest rate. I wasn't going to go there, but I feel like that's the consumer metric that everybody's kind of zeroed in on, although we know it's kind of just one of the metrics. But they're coming down, low 6s. It's starting to flirt with that 5 range. Very interesting to see that happening. You got Jerome Powell, I think, in his most recent stuff, he dropped a quarter basis point. So what's the significance of the interest rate today? And, can you demystify maybe some of the people who are correlating the Fed fund rate with mortgage rates. And I know you've done a lot on that particular topic, but if you could just touch on that and where you think interest rates are going and why would be great.
Yeah. So unfortunately, this isn't necessarily great news, but the same thing that tends to drive real estate values going up, inflation, is the thing that tends to drive mortgage rates to go up. And so without going into all the detail, like you pointed out, when the Fed decides to cut their interest rate, they control one particular interest rate. That doesn't necessarily impact mortgage rates. What impacts mortgage rates is this thing called the bond market, the U.S. Treasury bond. So when the government needs more money to spend, they issue debt in the form of bonds. Investors buy those bonds and they demand a certain return on that investment. And so let's say I want to buy a 10-year Treasury bond. Basically, it's the government saying we need to raise, let's say I buy a $100 Treasury bond. Government says I need to raise $100. I say I'll lend you $100 and I want you to pay me interest for the next 10 years on that $100 investment, my buying that bond. And the government says, great. So how much do I need in interest over the next 10 years? Well, if inflation is low, let's say I think inflation is going to be 3%, I might be happy with 3.5% because I know I'm buying the bond just to preserve my money. It's wealth preservation. I'm not looking to get rich off the bond. I'm just looking for a safe place to put my money. So if inflation's at 3%, I might be happy to accept 3.2, 3.3, 3.5% return on that bond. But let's say inflation's at 4%. Am I going to accept a 3.5% return on the bond? No, because I'll lose money over 10 years. Inflation's at 4%. I'm only getting 3.5%. So now I'm going to demand a higher yield on that bond. I'm going to need at least 4%. And if inflation's 4.5%, I'm going to need at least 4.5% return on the bond. And so the higher inflation is, the higher the yield I'm going to require on that bond. And then at the end of the day, that bond, 10-year Treasury bonds, whatever they're paying, whatever yield or interest rate they're paying is ultimately what drives mortgage rates. And so as inflation goes up, investors demand higher interest rates on these bonds. As they demand higher interest rates on these bonds, mortgage rates go up. So inflation drives mortgage rates. And again, the same thing that's helping our real estate. We like high inflation because it means rents are going up. It means that housing values are going up, but it's the same thing that drives mortgage rates.
Yeah, thanks for touching on that, Jay. I'd like to kind of bring it back to the house flipper. So, if people get it, things are happening. It just is the circumstances we live in. They're still flipping houses. They're doing it smartly. They're making money. It's good in their sense. Things change, and the real big thing is you don't want to get caught holding the bag.
Yeah.
So what should house flippers today, like what metrics or data are the most important ones for them to keep their eyes on as they're continuing with their business, just to make sure that they're ahead of the curve and they don't get caught holding the bag?
Yeah, so there are a few things. Number one, you always want to be cognizant of the supply in your market. So we have this thing called months of demand when we sell houses or buy houses. And it basically tells us, given all the houses that are currently listed on the market right now in a certain area, and given how quickly houses in that area are selling, how long would it take for all the houses currently listed to sell? And that is measured in months. So historically, 6 months is about the average of how long it would take for all the houses that are currently listed based on how fast houses in the market are selling. 6 months is about how long it would take to sell all the houses. And we refer to that as 6 months supply. And we tend to think that anything less than 6 months, so if we could sell off all those houses faster than 6 months, then that's a seller's market, because sellers are in a better position because houses are selling faster than average. Anything longer than 6 months is a buyer's market. Things aren't selling quickly, so buyers can demand lower prices. They can ask for concessions. They can ask for price reductions, whatever it is. And so we tend to want to see markets that are less than 6 months in supply, because again, that's a seller's market. These days, we're still seeing a lot of markets that are 3-4 months of supply. And so that's good. I mean, it may not feel as good as it did a couple years ago when we were at a month supply, 2 month supply. Literally, houses were flying off the shelves. But things are still pretty good in most markets. We're still seeing under 6 months of supply, but we're creeping up. So the first thing I would tell people is pay attention to how much supply is in your market. Talk to a local real estate agent or a local broker or a local appraiser, other investors, but be cognizant of that number. And if today we have 3 months of supply and next month we have 4 months of supply, that means that things are slowing down. It's still a seller's market, but it's not as good of a seller's market. Once we hit that 6 month mark of supply, that's when we move into a buyer's market, and brokers and real estate agents start telling their buyers, we're over 6 months. Now's when we start asking for lots of stuff. So that's the first thing to be cognizant of, what that total supply number is in months and how close we are to 6. Number 2 is really be cognizant of what's going on with the inventory in your market in terms of condition. This has been the biggest eye-opener for me, both in the single family and the multifamily world. And that's that we buy a house and we expect to renovate it to a certain level because we're looking at comps. We're seeing other things that are selling in this area have new countertops and new cabinets and new roofs, and I need to renovate to a certain standard to get a certain price. But as we get into a worse market, if we're heading into a softening market, what you're going to find is prices might come down a little bit in some markets, but at the same time, the condition of the houses that are hitting the market are coming down because we have more foreclosures. We have more distressed sellers selling their properties, not fixing them up before they sell. And so your competition is coming down. So it's possible that, yeah, maybe you're in your market, you can only sell for $5,000 less than you could a month ago. But at the same time, maybe most of the houses that you're competing against now don't have new roofs, whereas they did it a month ago. So you can save $15,000 or $20,000 by not putting on a new roof. So you lost $5,000 in sale value, but you save $15,000 in repair value because none of your competition now is putting on a new roof. They don't have the money or their foreclosures. And so even if we see a situation where values might start to come down, that could be an opportunity for us to change our rehab strategy, still compete with the houses that are out there, still be better than the houses that are out there, but spend less money. And so that's a big thing to watch too. We always assume that like the comp study we did when we bought the house is the same 6 months ago as it is today. That may not be true. It may be that a lot of houses that are hitting the market right now are a whole lot more distressed than they were 6 months ago. So you don't need to do as much of a renovation to compete.
That's such a good point. On the ground today, we have a member. His name's Daniel Puz. He's out in Nevada, Vegas area. Yep. And great. He's an agent, a broker. He's a house flipper. He's just engulfed into that market. He's a really savvy guy. He actually shifted his strategy this year to what we now call a wholesale. Mm-hmm. Basically, we buy it, we do minimal stuff to it, list it, and sell it. And his business is doing way better because that's what that market is allowing.
100%. And so I think I talked about this in the book, but when I underwrite a flip, what I do is I create multiple exit strategies. I create multiple renovation and exit strategies, and I assign numbers to each. So for every flip I do, the first thing I say is, what do the wholesale numbers look like? I buy it for X. I put $0 into it. What can I sell it for tomorrow? And maybe I'm getting a house at $80,000 that I can turn around and sell for $110,000, make $30,000 without doing anything because I got a great deal on it. So that's the first scenario. Second is that wholesale scenario. And by wholesale, in my definition, people have different definitions. My definition is you go in and you do the big ticket stuff. So maybe there's a hole in the roof that's water's leaking in. So you go, you fix the roof, you fix the drywall, you fix any mold that's in there. The house you don't fix up, you don't do a full renovation, but you fix that big issue that would keep somebody from being able to get a mortgage because it might not be insurable, or it might keep a new investor scared from buying that house. A lot of investors don't want to buy a house with mold and a hole in the roof, but they don't mind once you fix the roof and the mold and the drywall, they don't mind coming in and doing the cosmetic renovation. So you're basically fixing up the house just enough that you're going to create a new set of demand, a new buyer demand pool for that property. And so you might in that case, buy that same $80,000 property, you put $20,000 into it and you sell it for $160,000. So now you're making $50,000 minus all your holding costs. So that's better than the wholesale scenario. Then you do the next scenario. What if I go in and I just make this house nice enough to be a rental? I don't replace the flooring. I don't replace the cabinets. I don't replace the HVAC or the roof. I just clean it up and I make it as a nice rental. Now I open up a buyer demand for landlords. And maybe I can put $40,000 into it to make it really nice for as a rental, and I can sell it for $200,000 to a landlord. And now my margin's gone up more. Then I do another scenario and I say, well, I want to do a full rehab. I want to go in, I want to do full cosmetic. I want to replace all the mechanicals. I want to replace the roof. I want to do a bunch of nice landscaping. I want to put a fence in, all of these things. Now maybe I'm spending $70,000, but now maybe I can sell it for $250,000. So that's another scenario. And then I say, well, let's think of the final extreme scenario. Maybe I go in and I knock the house down and I build something new. And most of the time in that scenario, you can't make money. It's going to cost you more to buy it, knock it down, rebuild it than what you can sell it for. But there's some scenarios where that's actually the best scenario. And so I have each of those 5 scenarios, or maybe I have 10 scenarios or 4 scenarios, whatever. I create a whole bunch of scenarios, and then I look at the numbers and I say, this one generates me this much profit with this much work. This one generates me this much profit with this much work. And generally one of those scenarios is going to stand out as this is the obvious right choice. I put in this amount of work, I get this much profit. That's a much better scenario than all of the others. And then that's how I decide how much renovation I'm going to do on that property.
Yeah, that's, that I think that's the skill level in which, you're going to have a really strong business when you have multiple options. This year, Jay, we've done a lot of foreclosure houses we've been able to purchase. Believe it or not, it's our best campaign in terms of us marketing to people. Yep. And we've already done $1 million in gross profits on just that one strategy in Tennessee and Georgia, specifically non-judicial states. So, yep. And then that's what we do. We look at all the different exits on it, and it's not just margin, because I might make $80,000 on a deal, but it could take me 12 months because it's a big old rehab. Or I might only make $40,000, but I'm going to do it in 3 months.
Yep. Or you might make $10,000 and you do it overnight by just wholesaling it to another investor and never even stepping foot in the house.
For sure. Yep. And I think some of that, there's a factual number that makes sense, but there's also considering your business, the cash flow in your business, the capacity of your team, how many rehabs you have going on. And I think we've got some really, really savvy, impressive investors. And I'll tell you, the best ones have multiple exit strategies, period. Their businesses are strong because they can do multiple things with that asset class.
Yeah. Sorry.
Go ahead.
No, I was just going to say, and the other thing to keep in mind, you made a really good point about the capacity of your contractors. In my mind, I've always treated this business, again, I've done more scale than a lot of people, although I'm sure a lot of your folks are at scale. If you're doing a flip a year, 2 flips a year, this isn't as applicable to you. But if you're looking to get to scale, the key is you need to turn over inventory quickly. It reduces your risk, it increases your profits, and it also allows you to build economies of scale with your materials, with your labor, because you're giving them more work. You're buying more materials, you're using your labor more. And so turning houses over more quickly is really important. And so what I used to find when I was doing higher scale, higher volume than I am now, was if I needed to make a decision, if I had 2 strategies that were kind of equal, one involved a month worth of work making X dollars and one involved 6 months of work making maybe 3 or 4X. And otherwise they seem like pretty comparable scenarios in terms of time and effort and money, I would always go with the shorter one. Because at the end of the day, I would rather do more deals than do bigger deals if it's going to end up the same at the end, especially in a market where things could change, especially in a market where we could see some softening, because you'd much rather get out of a house in a month than take the risk of holding it for 6 months if there's a risk that the market's going to soften and values are going to stagnate or go down. And so generally speaking, I like the faster exit strategies, all other things being equal. But you need to look at your business in real time and say, how many contractors do I have access to? What's the price of materials right now? What are all these other factors that are going on, and kind of make a good game time decision? I think that's the best folks in this business are the ones that can look at every deal and make a really good decision for that particular deal based on the conditions today, not just a set of heuristics that they apply in every situation.
Yeah, that's fun. And time is a critical factor. Like the moral of that story is time is the critical factor for an investor. And even if you look at, I invest in stocks, well, guess what? 30 years in the market's going to do pretty good for you. Time's a critical factor. If you're moving inventory, shorter time is better. And that's what we're doing in house flipping. We're moving inventory. And of course, I love the markets that have the rental exit, because that's, like, to me, that's just such a good safeguard. And I know you were in the North Carolina market where they had a good rentals for a while. I believe you were. If that's
I was actually in Atlanta. We started in Atlanta.
Atlanta, yeah, which Atlanta has grown in prices, but that's been a great rental market for many years, and population growth and all those things. So time is a critical factor. Multiple exit strategies also a critical factor. Okay, just my last one for today, Jay. What do you see? Because we talk about risk and opportunities. So over maybe just the short term, 12 to 18 months. What do you see as a major risk to house flippers, and what do you see as the major opportunities to house flippers?
Yeah. So the biggest risk is obviously the market. We don't know what's going to happen. There's no doubt going to be some markets. We're still seeing a good bit of population movement in this country. Everybody knows that back during COVID, there was big shifts in population from certain states to other states. And a lot of that is kind of reversing over the last year or two. A lot of people going back to work. So that means they have to go back to where their jobs were. A lot of people getting new jobs. So they have to go to where their new jobs are. A lot of people who just, I know I live in Southwest Florida. I live in Sarasota. This was the fastest growing city in the country for a few months back in 2020, 2021, because it was, and I know you're not too far from here. Everybody came down here because it was inexpensive and it was beautiful. And unfortunately, it's still beautiful, but it's not inexpensive anymore. And so we have a lot of people who came down in 2020, 2021, who are now like, I can't afford to live here anymore. So they're going back to where they were. And so we have lots of population movement, and that's causing prices to kind of do weird things in different markets. Some markets, prices are going up because people are moving in. Other markets, like here where I am in Southwest Florida, values are dropping because people are moving out. And so I think the biggest risk is going to be market risk. We're not on back in 2020, like on a national level, everything went up. Back in 2008, on a national level, everything went down. We're in a situation where I think we're going to see very disparate markets across the country. Some are going to do well, some are going to do bad. So make sure you have a good handle on your market and the fundamentals: population growth, employment growth, wage growth, employment diversity. These are the things that you should look for. So that's the biggest risk. In terms of opportunity, I think the biggest opportunity is that there's still relatively little competition, given where we were 6-7 years ago. A lot of people are still terrified to flip houses. They don't understand it. And I have a good barometer. It's funny. I wrote the book on flipping houses back in 2013. And what I found is I can correlate book sales to how much competition I'm seeing in the market. How much competition for deals. And so I'm seeing a lull in book sales over the last 2 years that I believe is correlating directly to less competition in the market. Obviously, houses
you're spot on, by the way, Jay. Like, I mean, we do lots of marketing direct to sellers. So we know, like, 2021 into early 22, like, we're competing against 30 people talking to the same seller.
I can't even tell you how many books I sold back in 2020 and 2021. It was crazy. And so, yeah. So
you're spot on.
Yeah, so I'm seeing that correlation. And so I think there's a lot of opportunity just in terms of lack of competition. Everybody's waiting for the perfect time to jump in. People don't realize that when it comes to house flipping, there's no perfect time. Everybody, I mean, half the people see I started in 2008. Like, I wish I would have started in 2008. You could buy any house. I mean, literally, I could put the MLS up on a dartboard, throw a dart, whatever property it hit, whatever address it hit, I'd go out and buy that property and I'd probably make a lot of money. But here's the thing people don't realize. It was really hard to sell a house back then. People couldn't get mortgages. People couldn't qualify for mortgages. If they could qualify for mortgages, they half of them lost their job between the time they qualified and they actually closed on the house. Fannie Mae or FHA had a whole bunch of rules. I don't know if they're still there around reselling houses that were purchased as foreclosures. There was a whole bunch more rules around short sales. I mean, it was really hard to sell houses back then. And so in any given market, it's either going to be hard to sell or hard to buy. It's never going to be a perfect time where it's easy to buy and easy to sell. And so a lot of people don't realize that. And so there are a lot of people sitting on the sideline. And so I think now is a great time to be over the next, I think, year or two will continue to be a good time to get in without tremendous amount of competition. So I think that's the biggest opportunity.
I love that, Jay. One interesting thing is I went back a while ago and I did a study on media. Like, what was the fear mongering over the years, right? Like every year you go into the news and you look up from 2008 forward to some reason that the market is crashing, everything's bad. What's really fascinating, and I'll end on this, but what's really fascinating is in 2008, when you were buying houses, people were like, the news, I gotta imagine, was like, do not touch real estate. Yep. It's the scariest, it's the worst thing ever. It's never coming back up. And so like if people are seeing that today, let's say they want to get into it and they're like, oh, but the news is saying this. Newsflash, it's always saying that.
It's always saying that. They're trying to sell, and they do that through fear. And so don't buy into that. And the other thing to keep in mind is if the people that are doing the news, if they were experts in real estate, they wouldn't be doing the news.
That's right.
So everybody thinks they're an expert, but the reality is that the conventional wisdom is often wrong, especially when it comes to investing. Yeah,
for sure. Jay, I'm such a immense amount of gratitude. Love you and your family. Love what you do for the real estate industry, man. Really excited to see you in November in Clearwater Beach. It's going to be great to get you in a room with a bunch of house flippers. I think you'll be excited. So. I'm looking forward to it. Can't wait to see everybody there. So anybody that's listening to this, make sure you come see me in November. I'm looking forward to it. Awesome, brother. Awesome. And for people who want to get plugged in, I know you have a great newsletter, you have the podcast. How can they find you? Yeah. So jscott.com, the letter J, SCOTT.com. That'll link you out to everything. Cool. And we'll put that in the show notes, of course. And I really encourage people to get plugged into Jay's newsletter. I appreciate you. I appreciate your community and look forward to see everybody out there. Hey, if you love today's guest, we're doing an event November 5th through 8th. In Clearwater Beach, Florida. It's members only. It's very exclusive. No selling. It's just going to be an amazing event for real estate investors, house flippers, and entrepreneurs. You can apply to come. Now, you'll have to pay for your spot, but you could get in the room with some of the best house flippers in the United States. I highly recommend you apply. Click the link below. Apply to come to the event. If we select you, I'll see you in November 5th through 8th, Clearwater Beach, Florida. See you there.